Hello there, everybody. Welcome to Rosenberg's Research latest webcast. I'm Rudyard Griffiths, your host and moderator. Terrific to be here. Terrific to have all of you joining us live right now. Today, we're convening a super timely discussion. It's taking place right on the heels of that important Fed meeting yesterday. And we have as our distinguished guest one of the most influential, prescient, and bold thinkers on investing in economics today, Guggenheim Investments' Scott Minerd. Before I introduce Scott, let me welcome first, though, to the podcast, the person who is responsible for all these events, for all of us getting the opportunity to kind of dig into the big brains of the Scott Minerds and others of this world, and that is the irreplaceable and irrepressible David Rosenberg. David, say hello to everyone.
Well, glad everybody has come on the call today. I know we've had a lot bunched in the past few weeks, but with oil doing what it's done, Mike Rothman, we had to have him on. The last time when we had the Fed on, Paul McCulley, and we had planned this a long time ago with Scott to do a year ahead with the final webcast series. And Scott and I go back a long time, and I think this is going to be a lot friendlier conversation than the one with Martin Barnes when we almost attacked each other remotely. So I think that maybe there's shades of gray of difference between me and Scott in our views, especially on the near-term outlook for the Treasury market. But I'll let Scott do his talking. But this is very exciting. Scott, I want to thank you at the get-go for taking the time.
Well, David, it's such an honor to do it. As you say, we go back a long way, and I am always, I find myself a lot of times like you being a contrarian by most people measure. But, as I say, I'm not a contrarian for the sake of being different. Let's put it that way.
Well, Scott, David, so much to cover in the next hour, so let's get going. And the first thing I got to do, Scott, is introduce you to our audience. It's my pleasure to acknowledge you as the chairman and global CIO of Guggenheim Investments. So just to remind our viewers that you are actively overseeing the management of some $300 billion in assets across fixed income, equity, and alternative strategies. Scott, you've had a fascinating career from Morgan Stanley to Credit Suisse. You've recently completed a second term as a member of the Federal Reserve Bank of New York's Investor Advisory Committee on Financial Markets. You're a member of the International Monetary Fund's External Advisory Group, the Asia Sustainable Infrastructure Advisory Panel. Boy, I'd love to hear those acronyms. They've got to be big ones. And the Board of Overseers at one of my favorite institutions, Scott, a great place for independent, clear-minded thinking in this world, the Hoover Institution at Stanford University. And I'm sure many viewers right now, just like me, see Scott regularly and kind of hang on his every word, from the Wall Street Journal to the Financial Times to Bloomberg to CNBC. Scott, it's my opportunity, my privilege here to just tee up the first question. We're going to have a very informal discussion together over the next hour, questions from viewers. David's going to come in with his thoughts, but I want to begin by just giving credit where credit is due. You made a very contrarian and ultimately spot-on call earlier this year, despite a lot of inflation hysteria from your peers and by the communitariat. You called for persistent low rates into 2021. Where are we at now? Just look at the 10-year. You got it right. So my question to kick this off is, what comes out of yesterday's Fed meeting for you? Does it change any of your thinking about the future trajectory of rates and your lower for longer thesis? Maybe we could start there.
Sure. Well, Roger, I appreciate that. What we got yesterday was what was advertised, and that the Fed had pretty clearly telegraphed what they were going to tell us. But I think what the market reaction is showing is that this pivot, which I really do believe it is another pivot from where we were a few months ago, from endless quantitative easing, it seemed, and distant tightening, to suddenly we're going to accelerate tapering and talk about 3 rate increases next year, as akin to slamming on the brakes. Alan Greenspan once famously referred to a raise in short-term rates of 1/4 of a point as tapping the brakes. In this case, I would say, well, we're slamming on the brakes. A lot of the inflation data, I can talk at length about it, and I got asked the question on Bloomberg just yesterday. Scott, who would have believed that we would have inflation at these levels and rates here? Who would have ever thought that? And I said, well, I did. The reason that I said that is that when you go back to the experience we had after the Second World War, and a lot of people have drawn the analogy to the pandemic to war. We had run massive deficits. There was a large amount of financial repression in the economy. When the economy had to transition from a wartime economy to a peacetime economy, we saw inflation take off, and interest rates remained low. And so this, to me, if you want to keep that paradigm going of a war, then we're having exactly what we would expect at the end of a war. The thing that's troubling to me is that a lot of the pressure we've seen in prices have been associated with goods which have been associated with the supply chain or have inelastic supply curves. That is that it's very hard to change the number of airline seats on one day's notice. It's hard to increase the amount of oil in the short run. And these are things that we've seen price pressure in. And yet, at the same time, those are also, as goods with inelastic supply curves. Once the demand tapers off, the price will come down rapidly, or in the long run, the supply curve is elastic, and we will have more airline seats in the air, and we will have more cars, and we will have more chips, and we will have more oil. And so, the goods piece of the equation, I think it will reverse itself just like it did in the 1940s. Matter of fact, that episode that I talked about when rates were 2.5% and the inflation was at 20, 2 years later was followed by outright deflation, and rates, were then highly positive. So, when I look at where we sit today, this sudden need to react is, I think, an overreaction that's being forced by political pressure. And I'm not saying that QE should continue. I think we should get off the addiction of printing money and slow down the printing press. But to suddenly be talking about, tapering in 3 months and then raising rates, and then even in the press conference, the chair got into this discussion about shrinking the balance sheet. And I got to say, I was like, oh my God, did we learn nothing? The last time we attempted to shrink the balance sheet and raise rates at the same time, we had a lot of dislocation in the financial markets, and financial assets at those times were nowhere near as inflated in price as they are today. So I think the Fed has themselves painted into the corner, and I just don't see how that is going to translate into higher interest rates in the near term.
So David, let's come in with your analysis of that Fed meeting yesterday, and what would you like to add to Scott's take here? Because I know you guys share a lot of similarities here. So if you could be kind of additive, maybe take it in a new direction. This call ostensibly, David, is about 2022. So, project forward here. Scott's saying 3 rate hikes next year. Do you agree? Scott's saying a clear end to QE. Do you agree? I want to hear the thesis for rates and the Fed for 2022.
Well, I don't know if Scott said 3 rate hikes or if he just mentioned that the Fed's snuck in an extra rate hike next year, which is what the futures market, basically had already been priced in. The taper is a reality. And they're going to wind it down by the end of March. it's going to be a form of a liquidity constraint on financial assets. They should have really started doing that a long time ago, like the Bank of Canada did, with perfect hindsight. I never found that QE, even with the Bernanke repeated QE programs, never really had much of an economic impact directly. It was always aimed at trying to create a wealth effect on spending via financial asset inflation. And then what happens is that, it's like Mary Shelley's Frankenstein. You build up the monster and then you have to tear it down. And we've seen this before. So it's not really, to me, much about QE. We all know, and I know that Scott has said the same thing, and we went back to the last cycle, and when they reduce or unwind QE, let alone QT, it actually bond yields go down, and the stock market tends to struggle. So notwithstanding the knee-jerk reaction yesterday, the outlook is very clouded, I think, for risk assets over the near term. The rate hikes, I don't know. It's not my forecast. I don't tell clients, well, this is what the Fed is saying, and therefore I'm going to adjust my forecast for 3 rate hikes. I don't think that they know. I think it's basically ridiculous in the face of the spread of this new variant to be contemplating. We know the Bank of England raised rates today. I think that's absolutely crazy. And I think if the Fed raises rates into this bog of uncertainty, the risk of a policy mistake is very high. So I think that, look at the history of the Fed. They started producing these forecasts back in 2012. Their record in calling the overnight rate, which is the rate they control, is abysmal. I think it's probably their call on the funds rate is worse than most economists on Wall Street, believe it or not. And then they're always too hawkish, and that's because they're wed to their ongoing abelian view. You see, the Fed as an institution has to be a cheerleader for the economy. He has to be. And Powell was a huge cheerleader yesterday. But raising rates next year, I think we'll be talking about something totally different 3, 4, 5 months from now. We talk about pivots. When you take a look at how the Fed has missed the dot plots on the aggressive side, it's almost an easy bet to take the other side of that forecast. So actually, I'm sticking to my view. But then again, I don't have 4% GDP growth next year. I don't know how the Fed has growth next year double potential. If I had their 4% growth forecast, I'd probably be raising interest rates. I think that by the spring of next year, their forecast for next year's GDP growth, in the face of the immense fiscal withdrawal that we're going to be seeing, which nobody talks about. So I doubt, I don't have the Fed's 4% forecast. I'm actually 2%, a little bit less for next year. And so I think against that backdrop, the Fed's going to end up doing another pivot in another direction. So I don't think they're going to be hiking rates at all. That is still my view even after yesterday.
So Scott, come in on 2 things here. One, policy mistake. What are the odds here? I mean, is there the potential here for course corrections over 2022? So the Fed pares back and you don't have a policy-induced, recession out in 2024, 2025. What's your take on that? And second, I got to hear you on Omicron. I think all of us now have gone from, in the space of a week or 10 days, from just hearing about the latest variant to canceling travel plans, Christmas parties, dinners out. It really does feel like a switch has been flipped, and I'm wondering if you think that has a longer term effect. Is this a short term thing? I'd love to hear you on both those. Sure.
Well, first off, I want to say I really appreciate David stating what he did, which is I'm not necessarily of the opinion that we will get 3 rate hikes. That's what the Fed's saying. And he is correct. The dot plot is a terrible predictor of the future. But the thing I will say, and I said this on TV yesterday, is if the Fed stays on the path that it's advertising, we will have a recession by 2023. And so to your question, is this are we at the brink of a policy error? I think we are. And what is disturbing to me in these policy moves, these sort of knee-jerk moves of the Fed, which I would much prefer to have a little bit more mystery about what they're doing, and to see them, be a little bit more forward-looking than so reactive. The likelihood that they prick an asset bubble by their hawkishness, I think, is extremely high. And in the process of doing that, history shows us that the Fed has one response to deflated asset prices, which is to pivot and start printing money. And so I'm really concerned that the Fed has built itself or painted itself into the corner and really is running out of options. I don't see any easy way out here in terms of reversing the policies that were put in place post-pandemic. I think that I think the risks to the economy are a lot higher than people are giving them credit for. And I loved David's word that when you're looking out into the fog of the next year, with there's a lot of uncertainty, and certainly Omicron is one of them. Personally, I think before this is over, we're going to find out that even once adjusted, for the population, that this COVID pandemic will turn out to be worse than the Spanish influenza. And so, I know that's a pretty dire thing to say, but, there's a lot of wishful thinking going on right now. The variant is highly, highly contagious. It is much more contagious than any other variant we've had. And, to rely upon the representation of the South Africans that, the symptoms just aren't as bad. Maybe that's true and maybe it's not true, but all I know is that every day I'm reading more and more stories about hospitals being overwhelmed. And, this is going to have some disruption. The one thing I will say, though, is that the likelihood that we go back to lockdowns and things like this, I think is extremely remote. And the reason is that, policymakers have suffered a lot of political backlash off of the lockdowns. Here in California, Governor Newsom barely survived a recall. And so I think, political figures want to get reelected, and they've discovered that lockdowns are very unpopular. And so whether it's good public policy or bad public policy, I don't think they're going to inhibit our social interaction by much. And that just, in my mind, increases how bad it's going to get. Because we're not even going to attempt to constrain what's happening. And I'm sorry, even here in California, where I've been told that I think as of, I forget what day, Wednesday, I forget when it is, I have to wear a mask everywhere I go. I can tell you that nobody's paying any attention to the mask mandate. So it doesn't matter.
Mm-hmm. Scott, you were kind enough to send over some cheat notes for me in advance of this call. So I want to just continue this theme, this conversation around rates. And you've indicated in these notes that a sense that the 10-year should continue to fall through the end of this year, but rise in 2022, peaking at approximately 225 basis points in 2023. I wonder if you could just unpack that journey for us and talk a little bit about what you think the major signposts along the way are going to be. And then David, I want to come to you because you were out with an interesting note today just about how sensitive you think our highly indebted financialized economies are to rising rates. And you feel that rates have far less room to move on the upside before they are necessarily going to come crashing back down to earth. So I want to get those 2 points of view from you. But Scott, I want to start with you and the outlook through 2022 into 2023.
Yeah, I think that in the short run, I could point to a lot of fundamental factors. What David already talked about, the fiscal withdrawal, the reduction in the size of government deficits and spending, which I do think is important. But there's also a cyclical pattern to rates, and there's a seasonal pattern. And being an old bond trader, I tend to pay attention to those kinds of things. And I see downward pressure on rates, ending sometime around June of next year. The 2.25 peak, I want to be careful with that too. Is that's as high as I think we could possibly get rates to. And I'm in the same camp with David. The economy is so over-levered that we cannot endure high interest rates. So, I think 2.25 is the outside maximum on the rate. I tend to think the 10-year note will end up somewhere more between 1.75% and 2%. And I don't think we will be able to sustain that rate. I think that will be high enough to inhibit economic growth, squeeze corporate cash flows. One of the things I love these comments about corporate earnings and corporate cash flows. They sort of drive me a little nuts. They say, oh, corporate earnings are doing really well. We're at record corporate earnings. Margins are at record highs. I'm not disagreeing with any of those statements. They're all true, but or at least true for most of my lifetime. But the thing is that the earnings are concentrated in a small percentage of the companies, and unless we're going to move to corporate socialism, where companies that are having weak cash flows are going to get transfer payments from other corporations with big cash flows. The reality is that we have still a large number of businesses, industries in this country where the cash flows are not good, they're not strong, and that when you start to raise rates, you're going to compress their EBITDA margins if they have any, and they're going to have a hard time servicing their debt. It's interesting. I had to explain this again just yesterday, that it's a domino effect, right? I mean, one company files for bankruptcy, it goes out of business, it downsizes, whatever it has to do. That spills on to another company, which spills on to another company. And it's not like everybody, goes out one day and says, okay, all of us are going to have our earnings fall down. All our earnings are going down 20% all at the same time together. I mean, it doesn't work that way. And so we do have a lot of over-levered companies in this country. We have an over-levered government. And so, the pressure on the ability to absorb high rates, I think, is extremely limited unless we have, an overt change in policy, which to me sounds more frightening than the other one, which is that we just decide we're going to accept very high levels of inflation in this country, and that's not the message that I'm hearing today.
Mm-hmm. David, your note out today saying max 1% fund rate this cycle. What does that predict and project out for you in terms of, like, let's say the 10-year, just to match you up with Scott here to understand where you're at on a ceiling here for rates, for the cost of debt going forward, again, in a society that is just financialized to the gills?
Well, look, why the report came out this afternoon, and it was done meticulously. And the finding is important because when the euro-dollar futures are priced for 2% funds rate, the bond market, when you look at what's priced in for the funds rate, call it 1.75. When we do the analysis and we say even if they try to raise rates, it will be even more truncated than what the Fed is forecasting, and even more truncated than what most economists are forecasting. I don't even know if they'll be able to raise rates next year. I'm not so sure that the economy is going to allow them to do that, you know, but we'll see. Just because they want to raise rates doesn't mean they're going to, and we know the history of the dot plots. It's important because if we end up being right, Treasury yields are going to continue to melt, and probably the 10-year goes down into a 1 to 1.25% range. And then at that point, like Scott, we'll have to evaluate, you know, whether or not it's time to, you know, to pull the plug on the bullish bond call, at least from a tactical standpoint. This is, nothing has changed. The demographics, the debt, disruptive technology, all the things that created the disinflation in the last cycle. We were supposed to get inflation under Obama, but it never happened. And then Trump was supposed to be massive cost push inflation. Well, that didn't happen either, because these are the other fundamental secular forces at play. My big concern is this, and it's what Scott mentioned. There's more instability in the system than people think, and I'm talking about the amount of leverage and the amount of speculation and the valuations. We have never gone into a Fed tightening cycle with valuations across the asset classes at these extremes. Scott was right about talking about earnings, because I'm so old. I remember the days when we didn't talk about EBITDA. You know, we just talked about reported earnings. So you can slice and dice earnings, but sales are sales. And the S&P 500 price to sales multiple just moved above 3. It's even infinitely higher now than it was at the dot-com bubble. The price to sales is at a 3 standard deviation event right now. We have, so Scott said, inflated multiples. I would say the stock market, even under today's interest rates, people always say, well, you can justify these valuations on, say, long duration assets because of interest rates. But actually, when we go and we take a look at the interest rate structure today and where assets are valued, let's take a look at the S&P 500, or let's take a look at single family real estate prices nationwide. They're 15% overvalued relative to the interest rate climate today. That's what people don't understand. That old argument about, yes, we can justify these multiples on low interest rates. No. You could have said that 9 months ago. You can't say that right now. And then if the Fed, by the way, if the Fed does what you want them to do, I mean, I can't believe everybody wants higher rates. I go on CNBC2, I debate the anchors there, and they say, yeah, you know, higher rates are great for the market. And I'm thinking, well, not at these valuation levels, and because the multiple is inversely correlated with the direction of interest rates. Interest rates go up, and the multiple will compress. And normally the Fed's tightening into an earnings upswing, but we're having peak earnings right now. There's a lot of challenges ahead for the market in terms of, I mean, the market is just really the multiplication of two numbers, earnings and the multiple. And so I would just say that if the Fed raises rates 3 times next year, and then we adjust where asset values would be under those rate increases, you're not just talking about a 15% mean reversion just to get back to today's interest rates. You're talking about the Fed raising rates 3 times. The mean reversion isn't 15%, it's more like 25%. Can you imagine what that does to the wealth effect on spending? That's how vulnerable it is. And so so we're going to get, I think next year will be a transition, all right. Next year will be a transition. I think there's a very serious risk. We will have asset deflation. Okay, and if you want the Fed to start tightening policy, remember what's happening in China right now. Okay, in the aftermath of what the PBOC has done. Now the PBOC is going to be easing policy next year, but home prices in China are going down. And it is such an asset-dependent economy. I've been in the business 35 years. I've never seen the U.S. economy. I was saying this in the last cycle too, and the cycle before that, but we've never been this asset-dependent. I think there's a mean reversion trade next year, and if the Fed wants to roll the dice, asset deflation will replace consumer and producer inflation on the front pages of the paper, and then with a lag, that's going to create, you know, from the demand side, everybody's so worked up over, you know, over the supply bottlenecks, and I can't even believe, like, and I wouldn't mind getting Scott's view on this. How can you tell the public, unless you're basically trying to bail Biden out because Biden's being blamed for all the inflation? I got to talk tough on inflation, but how can you go to the public and say that the new variant is only an inflationary event. Oh, its only impact is on the supply side. Never once talking about the impact on the demand side. On like the same day that we get a negative 0.5% print on real retail sales, he's talking about how great demand is. What is he talking about? That's in the past tense. So there's a double impact. There's a double impact on demand and supply that he didn't talk about. The one thing I'll just say as well from both Scott, I don't think the economy is going back in a lockdown, not in the US, but the economy was heading into a precipitous slowdown before it locked down back in January and February. You look at the numbers, people were getting scared. So, you know, I've already had, by the way, personally, 3 lunches in the next week canceled. And there's no lockdowns in Toronto, right? People who don't have the booster are going to pull back on their economic activity. We have the Fed chairman just talking about the one supply side impact of this development. It seemed to be a little disingenuous.
Scott, earlier you mentioned that you know, the Fed is under a lot of pressure to bring interest rates, inflation down by bringing your interest rates up, because look, there's a politics here. There's midterm elections next fall. This call is about 2022. A lot of people saying those midterm elections paved the way for Trump to potentially re-enter the U.S. political reality. So, I mean, how do all those dynamics play out? Because they have to be part of the kind of risk calculus that, you know, politically we're trying to understand, economically we're trying to understand. What is your take on it?
Well, you know, I think that I want to say one thing about what David just said, because he made a very good point, and that is that the impact of the virus on demand is instantaneous. On supply, I mean, we've got tons of ships backed up out in the ocean. I mean, that isn't what's going to get hit first. It's going to be the demand side of the equation. But anyway, to go to your question, first off, you know, economics drives politics, and the rhetoric around inflation and you know, of course, some policy blunders, you know, Afghanistan and other things for the president are going to make it very difficult to retain the House and the Senate, and so we're going to probably end up with a Republican House and Senate, which will be divided government, and you know, then of course we're not going to have anything like Build Back Better or any big spending programs, and I really think that President Manchin is doing the best he can to stop Build Back Better, so you know, it's going to be interesting to see. There's a big difference here. People compare President Biden's ratings today to those of President Reagan, who was mired in a recession at this point in his administration. But you know, President Reagan had a lot of tailwinds, and things turned around pretty dramatically. Now it's really hard to predict the future in terms of, you know, how all the things that will play out in the course of here to 2024. But I think it's you know, it's not really looking good. You know, the risks that we have to the economy, to the pricking of what I think is an asset bubble of sorts, is extremely high, and that would be better to have done and over with now if you were the president, so you are in the heels of recovery by the time the election comes. So, you know, I think that I think American politics are woefully broken, and unfortunately, any scenario that I can tell you that would reunite the country is not a pleasant scenario. It would be, you know, related to probably facing an external crisis, and you know, there are any number of places in the world where America is being challenged, and candidly, we haven't been doing a very good job with it. And so, you know, you know, I think America is going to stay mired in just a lot of, I don't want to say bad policy necessarily, but we're not going to see the good organized policy that we need to rebuild this country and get us out of the situation we're currently in.
David, would you agree that just, inflation is political kryptonite for the Biden administration? I mean, this goes right to their core base, lower middle class income Americans who are experiencing real inflation, food inflation, rent inflation. It feels like a tax. I mean, are you sympathetic, David, to the extent to which there are risks that inflation incurs that are greater than just economic at this point? That this is catnip for populists?
Well, let's take a few of the things that you said, and some of the things that Scott alluded to about, the principal drivers of this inflation in the context of the first global pandemic in over a century that has totally disrupted global supply chains. I don't know, is that really Biden's fault? I mean, Biden might get the blame for decades of globalization. The theory of comparative advantage created winners and losers, but America did come out for a net winner, in my opinion. And of course, people did get lost, which is one of the reasons why Trump got elected in 2016. But that aside, food inflation. So how is that Biden's fault that we've had droughts and we've had rains and we've had floods? Are we going to blame? So we're going to blame Justin Trudeau for just what happened in British Columbia. I mean, we've had in the major food growing regions of the world, this has been the equivalent of the Dust Bowl in the early 1930s, where the level of food prices in a span of 2 years doubled in the early 30s. We had actually swung inflation dramatically on that basis. I don't know, you blamed FDR for food inflation. I mean, people's diets didn't change overnight. So no, I don't think you can blame anybody for food. It's just bad luck. Are we to be, what about energy? So OPEC plus, we have to rely, and I guess we could talk about how we've underinvested in energy, although that's a new theme, because apparently there was this massive shale production going on for years and years. But I mean, how do you blame them for food, and how do you blame them for gasoline? I mean, is anybody blaming any political leader in Europe because natural gas prices in most countries are hitting record highs? It's only in the United States. See, what I'm trying to say here is in the United States, the blame game is so easy. I don't see any other leader right now, any other leader that's being so, and look, I'm not a huge Joe Biden fan, but I think he's being unfairly attacked for this sort of inflation that we're seeing. It's his fault, natural gas and fertilizer, global supply chains. You mentioned rent. Well, here's the story on rent. This is why we're going to have inflation melting in the second half of next year. Now, maybe to some people, that's just way too long. Everybody today is long-term, is lunch tomorrow. But I'm just telling you that what happened with rent, and it's important because it's 30% of the CPI and 40% of the core when you look at imputed natural rents, and they're perfectly correlated. How do you blame the fact that the apartment developers were told by all the experts in the winter months of 2020, nobody will ever want to live in a high-rise again. Nobody will ever want to live in a high-rise again. So if you're taking a look at whether it was starts or permits or completions, they fell through the floor. There was some time earlier this year where rental completions were down 42% on a year-over-year basis. Well, I guess that people do want to actually live in a high-rise. But you see, what happened is that rental demand hasn't skyrocketed. It's been fairly stable at roughly 1.5%. What happened is that everything got gutted. But just like the rental fleet and autos got gutted, and next thing you know, you got massive rental fleet auto inflation and used car prices. I mean, they dumped their fleet. Because we were told that it's going to take 5 years to get a vaccine. So why would you hold any inventory? And why, as an apartment developer, would you be building anything? And so that's what Scott was saying, basic economics. And in the apartment sector, which is important for the CPI, we had a completely vertical inelastic supply curve. So even a modicum of demand caused an outsized price increase. It's happened across so many industries. So what happened on the rental side, because you said rents, is very easy to explain. But we just got the housing start numbers today. And if you want to see a bull market going on right now, Okay, despite all this talk about shortage of construction workers, well, it didn't show up in the housing start numbers. When you're taking a look at apartment permits, starts, units under construction, and completions, they are surging. And actually, the most important number now that pertains to the second half of next year, we're going to get a flood of new rental supply. Nobody's talking about that. A flood of rental supply in the second half of next year. I've already traced it out that units under construction in the multifamily sector are at a 47-year high. Good luck if you're going to read that in the Wall Street Journal or listen to it on, on Bloomberg Radio or CNBC. So yes, it is transitory. But if you're so myopic and tempestuous and impatient that, and look, he's buckled, right? Another Powell pivot, transitory. In the overall scheme of things from an economic historical perspective, okay, I would say even 2 years is transitory. And you know what, I say that to people and they laugh at me. Okay, so maybe I'm just it's like a relic, but I would certainly say this, if you're gonna ask me, I don't shy away, I'm not embarrassed to say that it's transitory. I actually went to the gym and one of the trainers came up to me and said, I saw you on TV. You're still Mr. Transitory? This is a trainer. And I'm there thinking, okay, this is definitely, I know this is, by the way, Scott, this is 25 basis points ago in the 10-year note. I said, I got to be in the right course with that one.
Okay, let me get to some questions here that have come in from all the viewers tuning into this fascinating discussion. Scott, to come to you first, a question here saying, what do you think about the massive growth in bank deposits? Is this an indicator that the consumer is going to go all out in 2022, and hence that's maybe supportive of these optimistic GDP projections coming out of Chairman Powell?
Right. Well, first off, look, yes, that it is supportive, right? But one of the things that I think people miss is economic data. The way we talk about it is based on rate of change, right? So all of these transfer payments that came out, and some of them were saved, and I'm going to come back to that in a minute. And so consumers' balance sheets are in good shape, or at least a portion of the consumers in America's balance sheets are in good shape, except for those people that are living on the streets in LA. And so those people, they will continue to consume. But we've seen the big surge in consumption. I loved one of the guys who works for me as an analyst who does our economic research. He said, you don't get to reopen the economy twice, right? I mean, once it's out there, right? And so, that will be supportive. And I'm not trying to write that off, but there is another part of this, which is a large portion of this, I think, is not going to get spent. And the reason is that there are people who maybe were like my age, who said, hey, I went home from work, I lost my job, whatever, but I got all this money and my 401k is sky high now. And, I was thinking of retiring in a few years, so why don't I just retire now? And so they're not going to come out and spend that money. I mean, it's just permanently sitting there to be absorbed, to be spent over a long horizon. So, I don't think that it's not going to add to a positive rate of change, which is what we call growth. It's just going to be there, as part of the support, while other sectors of the economy, and in particular, as David mentioned, the government is going to be spending less, and we're going to have a lot of drag on the economy next year. And I can tell you, my economic research team that works for me gets frustrated with me because I'm like Debbie Downer or something. But it's as I tell people, I just like to look at the data and not get caught up in the hysteria. About transitory inflation. I'm actually, David, one thing I say too is I'm exactly where you are. I mean, transitory in my mind means it's going to be a couple of years, and that's what happened in between 1946 and 1949. I mean, we're not. What do we think? We're going to have a 3-month surge in inflation and everything was going back to normal? I just think that people are being unrealistic, and what's very disturbing is that the people that are supposed to be the level-headed people that are setting policy seem to be caught up in the same hysteria that the politicians are.
Yeah. Scott, any wild cards for 2022 that you're keeping an eye on? I noticed in your notes to me that you made a small amusing aside that, people are putting down payments on homes using Bitcoin, or, the sale of Bitcoin to, I don't know, there was other stats out this last quarter that, 1 in 20 Americans quit their job because they're trading cryptocurrency. I mean, are those just kind of factoids, we can ignore them, or are there a few of those that genuinely concern you, or do you just think warrant our attention?
Well, I think that the Bitcoin thing, and in terms of the down payments, is emblematic. It's not, the sole thing, but people have made so much wealth off of the appreciation of risk assets, of art, of all kinds of stuff, baseball cards. That they have the ability to rebalance their portfolio and sell some stocks and move to a house, or sell their Bitcoin and buy a house. But the thing that really bothers me or scares me, is the growing credit crisis in China. And this really reminds me a lot of 1997. And that is, I remember in 1997 when the Thai baht was devalued, I was like, okay, this is the beginning of the end. And people were like, what are you talking about? Thailand's like an economy the size of Maryland, right? I mean, how is this the beginning of the end? And I said, look, all of these nations out in Asia, they have comparative advantage. And so, one nation devalues, that puts pressure on another nation. And, eventually this is going to cascade across Asia, and, it's going to be a major problem. And of course, a year later, by the time we got to the second half of 1998, we were having the Committee to Save the World, and long-term capital was collapsing. In a highly levered market like this, where financial assets are so highly priced, it is hard for me to believe that the second largest economy of the world that's going to suffer probably the biggest component, 30 to 40% of its economic activity, that's now heading into paralysis, that in some way, shape, or form is not going to morph itself into something bigger, and is not going to eventually hit us here in the United States. So, I think the Chinese property issue is a huge issue, and the cognitive dissonance we have with it is that China, it's a command control economy. They're not going to let things fall apart. They'll handle it, so on and so forth. They will. But what will be the unintended consequences? What else will happen? And I think that is the number one concern I have going into 22. That something will be coming from the emerging markets that hits us here in the United States
in April. But I think inflation is going to come down significantly. And just remember, the last time inflation was at these levels back in it was the summer of 08. Remember what inflation did exactly 12 months later. It got me thinking about how is China going to replace that lost growth from their bloated real estate sector is going to be through exports. And now they're all of a sudden taking measures to weaken the yuan, which had been strengthening previously. And I remember we had Leland Miller on the last time. When I asked him this question, he says, well, you try and export your way in your growth model, you're not going to make friends. Well, China doesn't have any friends, so they don't have any friends to lose. So I don't think that's a viable answer. I think that they will be dumping a lot of exports into the rest of the world, and that's going to be a source of disinflation. In terms of what keeps me up at night, the answer to that never changes in my 35 years in the business, and I think about it constantly, which is, where's my blind spot? What am I missing? And so, yeah, I am concerned that my biggest concern, and I think I'm speaking for Scott here, is that the policy misstep is not that the Fed waited too long. They'll clean up QE. That'll be a good thing. I think the misstep will be that they are too overzealous to raise rates. I'm very concerned about all the talk, the political pressure. I mean, I don't know about you, Scott, I've never seen political pressure on the Fed to raise rates. We had Trump pressuring Powell to cut rates in 2018. I've never seen politicians pressure. So isn't that going to be great? Let's raise rates. We're 3 rate hikes away from inverting the yield curve or flattening it completely. And you don't even need to get a recession. You get growth below 2%, unemployment goes up. And so I'm there thinking, well, raise rates to slow an economy that's already fragile. You know, what keeps me up? Well, here's what keeps me up. What do we know? What do we know? We only know about how an economy can operate in a pandemic with a friendly fiscal and monetary policy. We don't know how the economy or the markets can respond in a pandemic, which isn't going away, once the fiscal and monetary tailwinds become headwinds. That's my concern, is a law of unintended consequences. So that's my primary concern. And I'll say, you know, on the geopolitical side, you know, we have a, you know, we have an administration, I think, that's viewed as being weak on foreign policy. And we have a lot of hotspots, not that we haven't had them before. Look, I'm getting questions. I'm not getting questions. We talked a lot on the last call with Leila Miller about what would happen China and Taiwan. But I'm telling you, a lot of really smart clients are sending me emails about, can you start working through what could happen between Russia and Ukraine? And there's a lot of people that I know that think that that is a serious possibility. So I'm not a foreign policy expert. Of course, I have to be a student of what's going around the world. But you know, you're taking a look, the Pentagon's expanding its budget. That's one part that isn't actually going to be slowing down. Japan, the historically pacifist Japan, raising its military budget. We know what China's doing. Defense stocks are clearly, to me, are a place that you want to be involved with if you're investing in the stock market. But I think geopolitical tensions next year are going to go to a new level. And I think that we should be thinking about how we hedge the portfolio against that rising risk.
Scott, just in our remaining moments, you've been so generous with your time. Any other, you know, big convictions for 2022? You've got a clear case and a conviction around yields. Is there anything else out there in terms of an asset class or a trend that you see that you have a lot of conviction at this moment around for the coming year?
You know, this has been one of the most difficult times in my career to invest. You know, one thing I would say is that I don't think the party is over. So I do think that risk assets, tech stocks will continue to do well. But, you know, I always tell people, you know, there's a difference, and I have to fight this myself. There's a difference between investing and trading, right? For years, my career was, you know, I was buying something today thinking that I could sell it tomorrow at a higher price, right? And investing, you're allocating capital for a longer horizon, right? So I guess I would sum it up with what I frequently quote Baron von Rothschild's famous words. When asked this secret of his great wealth, he said, "I sold early." I think that this coming strength in here is an opportunity to sell. And yes, you know, I had this conversation this morning with someone. You'll be punished for going to cash, you know, because you won't get any return. But you know, the old line that return of capital sometimes becomes more important than return on capital. So, and bonds, you know, not great long-term investments, but probably not a bad place to go if you think we're going to face the kind of challenges that we think are ahead.
Well, great, Scott. That's a fabulous point to wrap up with you. David, I just want to give you the opportunity to say any final words here and to thank our distinguished guest.
Right. Well, I think that, I mean, I'm out of breath. Although I think Scott and I could go on, together for hours on this. And so I just want to, once again, thank you, Scott, for taking the time in your busy day to come on the webcast. I'd love to have you on again. And my biggest wish, and I wish it was a forecast, but not one that I have tremendous conviction in right now, was that I may get to New York in the first half of the year, and we get back to Bobby Van's and have a steak together and a glass of wine.
Well, let me know.
Hope is not a strategy, so I'm not saying it's a forecast, but you're my first call when I come down.
I appreciate it, David. Yeah, I'd love to do that. And let me say one thing, that when the request came in, I was to do this today, I was so honored because David, you are one of the great thinkers in economics who truly is thinking rather than just reacting and let's say going with the consensus. So that to me is refreshing, because I find most people are so afraid to actually have a real opinion. And I get myself in trouble sometimes for that, but it seems to have worked for the client, so I'll take it.
Well, thank you again, Scott. Great to have spent this hour with you. And just to remind our listeners that you can catch archived versions of all of these webcasts at rosenbergresearch.com, including this one that'll be up shortly. So everyone, be well, be safe, get boosted if you have not, and we'll do this all again with David and company in the new year. Have a terrific rest of your evening. Bye-bye, everybody.